Dr. Chen here again, and welcome back. In today's short video, we'll be discussing stock splits. As you may know, in March of 2022, Amazon announced a 20-for-1 stock split. This is commonly known as a forward split, meaning that each old shares will get you more shares of the new shares. In this case, each Amazon share will get 20 shares of the new shares before the stock split takes place. Is it a great deal for shareholders to have a stock split? In short, it should have no effect on the current shareholders. What's the impact of this type of split on the index value? Well, it depends on the indexing method it used. Recall from your reading material that if an index is price weighted, then a forward split reduces the impact that the stock has on the index value. On a value weighted index, however, this practice has no effect whatsoever. Now we're going to construct a hypothetical index with some mega caps as an example. We're going to use Apple, Microsoft, and Amazon. Apple has split twice the last 10 years. Now, suppose that the index has those three stocks with 100 shares of Apple, 50 shares of Microsoft, and 5 shares of Amazon. Now, let's assume that the price for Apple was $150 a share, Microsoft was $250, and Amazon's was $2,600 before the stock split. Now, let's say the stock split in the next period, or the next month, or even next year. A share now trades for $180 for Apple, $330 for Microsoft, and $3,200 for Amazon, respectively. What's the impact of this price change on the index value? Let's say we start the index with a base value of 1,000. Here's the table summarizing the effect of a value-weighted index before the split. Now, notice that the index value went up to 1,246.91 after the price increase, which represents a 24.69% increases over the period for the index. Would the split by Amazon have made any difference? Now, let's take a look. Here's the table for the after split values. Notice that the only numbers that change are the number of shares and the price after the split. If Amazon went for a 20-for-1 split at day 0, then the index would have owned 100 shares at $130 a share. On day 1, after the split, the share value would be 100 again, but the price of the stock would now be $160 a share, not $3,200. That's the only difference. For price weight index, however, we need to calculate the divisor twice, once before the split and once after the split. Now in this case, because of the price weight index, we sum up the price of the stock first, not the value of the holding. And here's the result. In this table shows that the index value has gone up by 23.67%, a little less than the index value change after the value weighted index. The effect of the split by Amazon can be drastic since it has the highest stock price before the split. In this case, the value of the index has gone up by 26.42% after the split, higher than the 23.67% before the Amazon split. Why? Because Microsoft became the highest price stock in the index, and since Microsoft has the highest price change, it dominates the index value change. Now, a company might want to split stock for many different reasons. Tricking investors into thinking that the stock is now a bargain is one of the main reasons. Investors are not rational enough to know that a stock split should not have any impact on their wealth. The second reason is a stock split can entice a price-weighted index such as the Dow to include their stock. Apple split for that reason. My guess is that Amazon is probably thinking about the same thing could happen to its stock. Thanks again for joining me, and I'll see you in the next module.